Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Okay, picture this. Your company is looking at new frontiers. Maybe planning operations in Brazil, or setting up a key supply chain link in Vietnam, or even tapping into that booming fintech scene in sub-Saharan Africa.
Yeah.
The attraction of going global is huge, right? The opportunities can seem massive. Sounds pretty exciting.
Oh, absolutely. It is exciting. And the potential for, really significant growth in these regions is undeniable. But stepping back and looking at it from the finance side, these emerging markets present a very specific mix. It's rewards, yes, but also very real, sometimes quite unique risks.
Right.
So managing the financial strategy there, it goes way beyond just being good with spreadsheets.
Yeah.
It really demands, I'd say, deep adaptability and resilience, real foresight.
Adaptability, that's such a key word here. It's not just crunching the numbers, like you said. It's about navigating this landscape that can shift under your feet. And that unpredictability, that's precisely what we want to unpack today. So our mission for this deep dive is pretty clear. Let's define what really makes a market emerging. Let's explore the core financial challenges they throw up, and maybe most importantly, uncover some of the, brilliant strategies companies are using, not just to get by, but to actually thrive in these really dynamic, sometimes pretty turbulent places. So let's jump in.
Let's do it.
Okay, first things first, laying the groundwork. For anyone maybe newer to this, what exactly do we mean when we talk about emerging markets?
Yeah, good question. At their heart, emerging markets are really economies in transition. Think of countries growing fast, industrializing, but where the rules, the infrastructure, the financial systems, they're still developing. So, classic examples might be India, Brazil, Indonesia, Nigeria, Turkey. And what's really fascinating is this kind of dual nature they have.
Dual nature.
How so? Well, on one hand, you've got incredibly high growth potential. Often younger populations expanding fast, rising consumer demand that pulls in global business,
Yeah.
huge upsides.
Right, the opportunity side.
Exactly. But then that's balanced against, higher economic volatility generally,
Yeah.
potential political instability, and often legal and regulatory systems that are just less predictable than what you'd find in, say, Western Europe or North America.
Yeah.
It's very much high reward, but also high risk.
Got it. So translating that to corporate finance, what are the specific minefields finance teams need to watch out for?
Right. So this dual nature creates several key risk categories. First off, and this is a big one, currency risk. Local currencies in these markets can be incredibly volatile. Just imagine. Your revenues are coming in pesos or naira, but your key components, your costs, are maybe in US dollars.
Okay.
Even a relatively small shift in the exchange rate, if it happens suddenly, can just wipe out your profit margins. It's like building on shaky ground.
Wow, yeah.
Then you've got regulatory risk. This is about how quickly and sometimes unexpectedly policies can just change.
Like overnight.
Sometimes.
Yeah.
We're talking new capital controls maybe, sudden tax hikes, or even new limits on foreign ownership that can just reshape the whole market dynamic. That unpredictability makes long-term financial planning really, really tough.
I can imagine.
And then there's political risk. This is broader stuff, disruptions from elections, maybe wider government instability, sometimes even, civil unrest, all things that can directly hit your operations or your ability to get capital.
Okay, so currency, regulatory, political, what else?
We also have to consider liquidity constraints. Often the local capital markets, the places you normally go to raise funds, are underdeveloped.
Meaning it's hard to borrow locally.
Exactly. Hard to raise funds locally for expansion, or just as frustratingly, sometimes it's hard to get your profits out, repatriating them back to your home country. Imagine having a successful business but struggling to actually access the cash it's generating.
That would be incredibly frustrating.
It really is.
Yeah.
And finally, there are often significant accounting and transparency gaps.
Meaning the data isn't reliable.
Sometimes. It can mean limited data quality or local reporting standards that are opaque, maybe different levels of adopting international standards like IFRS, those global accounting guidelines. This whole patchwork just makes planning and oversight more complex than in a mature market, much less straightforward.
Okay, wow. It really does sound like a continuous tightrope walk. So the big takeaway here feels like emerging markets aren't just, tacking on another region to your existing model.
Not at all.
It demands a total rethink of the company's financial playbook. So
Yeah.
What does that rethink actually look like? Are there companies that have really figured this out?
Oh, absolutely. Some big names have been navigating these waters for decades, and they offer fantastic lessons. Let's take Coca-Cola in Nigeria.
Okay, Nigeria. Dynamic but volatile, right?
Exactly. One of Africa's most dynamic markets, but also, yes, volatile. So dealing with the Nigerian naira, which fluctuates a lot, they don't just rely on standard hedging like forward contracts, agreeing to buy or sell currency at a set future price.
Right, locking in a rate.
Yes. But what's really clever, I think, is that they strategically price some of their products directly in US dollars. They use quite sophisticated multi-currency pricing models.
So not just hedging the risk, but shifting the revenue base itself.
Precisely. It's about stabilizing their margins by, in effect, transferring some of that currency risk away from their local P&L. It's a really nuanced approach for a very challenging market.
That is fascinating. Okay, how about Unilever in India? They have that huge local subsidiary, Hindustan Unilever. India is known for its complex regulations. How do they handle that?
Unilever's approach in India is a masterclass in navigating complexity. They lean heavily on local joint ventures, partnering with Indian firms, and crucially, they employ highly decentralized decision-making.
Meaning the local teams have a lot of power.
A lot of autonomy, yes, and responsibility. Their finance teams back this up with very frequent scenario planning, which is absolutely essential given how quickly tax rules or consumer trends can shift in India. They're constantly modeling the what-ifs.
Constant adaptation. Okay, speaking of autonomy, Tesla in China, their first fully owned international plant.
That's right.
What challenges did they face being a wholly foreign-owned enterprise there, and how did finance tackle it?
Right. So even though Chinese policy allowed that wholly foreign-owned structure, Tesla still faced big hurdles, significant tariff risk, various regulatory hoops to jump through, and of course, constant currency exposure to the Chinese yuan. Their finance teams were incredibly strategic. They deliberately relied heavily on onshore financing, borrowing money within China, and they prioritized local procurement, buying components locally.
Creating a local cost base.
Exactly. Building a yuan-denominated cost structure. That dramatically reduced their exposure to currency swings between the yuan and the dollar. Plus, they focused on building really strong relationships with local Chinese banks for working capital, which is critical for just, keeping the lights on day to day.
Matching currency exposure on both sides makes total sense. Now, Nestle in Brazil, they've been there over a century. Brazil has that history of hyperinflation. How did they manage that kind of pressure?
Nestle's long history in Brazil really shows their adaptability, especially with hyperinflationary pressures. They actively use cost pass-through strategies.
Meaning they adjust prices quickly?
Immediately, yes. Adjusting prices to reflect rising input costs. And they use index pricing, where prices might automatically adjust based on an official inflation index. This is just vital to stop margins getting constantly eroded by rapid currency devaluation.
Constant vigilance.
Absolutely. Their finance teams are always modeling the fluctuations in the Brazilian real, and they strategically hold a mix of local debt, again to match local revenues, alongside USD reserves as a kind of safety net, a hedge.
That's incredibly adaptive. Okay, and Walmart in Mexico. Isn't that their biggest international division?
It is, yes. Their playbook there shows similar adaptive strategies. Heavy reliance on local sourcing, which reduces import costs and currency exposure. They use peso-based financing, aligning their debt with their revenues, and they employ rolling forecasts. These are budgets that are constantly updated, not just set once a year. It lets them react really quickly to shifts in local demand or changes in monetary policy. Gives them that needed flexibility.
Flexibility seems to be a recurring theme.
It has to be.
Okay, one more. The MTN Group in Africa. Big telecom player across many different African countries. That must be complex.
Hugely complex. MTN Group, based in South Africa, operates in over 20 countries across Africa. Different currencies, different regulations everywhere. Their financial sophistication is quite high as a result.
What kinds of things do they do?
They actively use techniques like cross-border cash pooling. That helps them centralize and manage their cash efficiently across all those different entities and countries. They use comprehensive currency hedging, obviously. And importantly, they apply risk-adjusted strategies across their whole portfolio.
Meaning they treat each country differently?
Yes, they explicitly factor in country-specific risks when deciding where and how much to invest or how to structure operations. It's not a one-size-fits-all approach.
That gives us a really good flavor of what companies are doing on the ground. So flipping it slightly, What kind of advice does a big consulting firm, say McKinsey and Company, McKinsey and KUHM Puni, give to CFOs navigating these markets?
McKinsey often advises multinational CFOs to apply country-specific hurdle rates when they're evaluating investments in emerging markets.
A higher required return, basically.
Essentially, yes. A higher minimum acceptable rate of return to compensate for the unique, often higher risks compared to investing in, say, Germany or the U.S.
Okay.
They also really push finance leaders to explicitly model things like political risk premiums, to carefully assess access to capital in that specific market, and to build FX exposure right into their basic net present value (NPV) analysis, the calculation they use to judge an investment's profitability. It's about baking those risks into the financial DNA from the start.
Right, not just adding a footnote about risk at the end.
Exactly. Make it core to the calculation.
Okay. So if we pull all these lessons, these real-world examples together, what are the really actionable strategies? What's the so what for our listeners who might be thinking about their own company's playbook?
That is the critical question, isn't it? How do you actually apply this? I think there are 5 key strategies that really stand out from these examples. First, use hedging instruments, but strategically.
More than just buying forwards.
Yes. It means employing the right tools, currency swaps, forwards, options to protect your cash flows from those wild FX swings. But it's also about building exchange rate sensitivity into your P&L forecasts, really understanding the potential impact before it happens.
Got it. Okay, number 2.
Second, adopt local capital structuring. Where it makes sense, try to raise debt in the local currency.
To match liabilities to revenues.
Precisely. It significantly cuts down that currency mismatch risk we talked about. And you should also look into maybe hybrid structures or even guarantees from multilateral banks like the World Bank. Sometimes they can offer lower cost financing or risk protection in these markets.
Interesting. Okay, third strategy.
Third, build flexible budgets. This is just absolutely crucial in unpredictable environments. Forget the static annual budget. Use rolling forecast budgets you update continuously. Use scenario models with wide tolerance bands.
Planning for the unexpected.
Actively planning for it. Supply chain disruptions, regulatory delays, sudden bursts of inflation. You need to anticipate these things, not just react when they hit.
Makes sense. Number 4.
Fourth, monitor political and regulatory signals relentlessly. And this isn't just about skimming headlines.
It's more depth.
Definitely. It means active collaboration, talking to local lawyers, political analysts, risk specialists, tracking policy developments almost in real time. Because what looks like a minor tweak from thousands of miles away could have huge financial consequences on the ground.
Right. Okay, and the 5th one.
Finally, and maybe this is the most important one, invest in local finance talent.
People on the ground.
Exactly. Having finance professionals in the market is invaluable. They give you that real-time pulse. They can advise on really nuanced, critical issues like the best way to repatriate cash, navigating complex local tax structures, handling compliance quirks that, frankly, a remote team might completely miss.
So the finance team's role changes.
It really does. It's not just about making the numbers work anymore. It's about proactively building resilience into the whole business model. It's about anticipating shocks before they hit.
That's a really powerful way to think about it, a shift from just reporting to actively building resilience. So, okay, let's bring it all together. What are the core strategic takeaways, the big picture lessons for listeners?
Yeah. The overarching takeaways, I think, are pretty clear. First, don't apply developed market assumptions blindly. Just don't. The rules are different in emerging markets.
Right.
Second, you absolutely must integrate political, currency, and liquidity risks deep into your financial models from the very beginning.
Yeah.
Don't treat them as add-ons.
Make them central.
Central, yes. Third, structure your financing and your capital investments specifically to withstand volatility. Build in that flexibility we kept talking about. And finally, use those tools, scenario planning, behavioral analysis, to proactively plan. Don't just react when things happen. It's really about building a robust financial fortress designed for the local terrain.
It feels like the expectation for finance professionals today, especially in global companies, is really evolving. You have to think globally, absolutely, but act locally and, like you said, model accordingly.
That sums it up perfectly.
It's definitely a challenging space, but sounds incredibly rewarding, too, for finance teams that get it right.
No question.
So a final thought for everyone listening. Given everything we've talked about today, navigating finance in these dynamic emerging markets, what's maybe one key assumption about international expansion that you, listening now, might reevaluate in your next financial model? And how could just shifting that one assumption potentially change your entire strategy? Something to mull over. Stay flexible, stay strategic, and stay sharp out there.
Absolutely.
Yeah.
And just remember, this journey of learning, of applying this knowledge in finance, it really is continuous. So keep exploring, keep questioning those assumptions you hold, and keep focusing on building that essential resilience into every financial decision you make.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.